I spent a lot of time, as you mentioned, in terms of my writing, in terms of meetings on Capitol Hill with Democrats, with Republicans, with the SEC, with regulatory bodies, with the Fed. And the reality is that there is a certain amount of lip service given to not having another financial crisis, to not having too big to fail, to, having banks do these stress tests with the Federal Reserve and kind of similar tests, but not quite as specific with other central banks around the world. And at the end of the day, there hasn't been a tremendous amount of legislation that can stop too big to fail. There was Dodd-Frank in 2010. I've written a lot about that in my books. I don't really think that has done very much one way or the other. I think banks are managing their risk a little better. That's true. I think they're diversifying a little better. So there is a sense that the biggest banks are a little bit more stable. But also, I don't think there's been legislation on that thing. So the problem has gone away. The crisis isn't immediate. And the banking lobby is very powerful. And so you put all that together, there actually isn't a lot of change. It's just that we've only seen sort of pocket crises of certain banks internationally, for example, in Switzerland, and some banks in the United States, some regional banks have gone under and have had issues, but it hasn't brought down the biggest banks in the banking system, all of whom are bigger than they were pre the financial crisis. If you look at Citigroup, if you look at JP Morgan, Chase, Goldman, and so forth. I think markets have gotten used to the fact that central banks help them, and that even if we look at the Fed, its book of assets is still in the high 6 trillions. It's still 2 trillion more than it was at the height of the financial crisis of 2008 post-COVID. It's come down from its very high highs of just under 9. But that's a lot of cushion for the financial system to recognize that if something were to happen, the Fed would step in and it would buy treasuries from them. It would basically have some sort of situation like that happen. And we actually saw that in March 2 years ago. So we can definitely see that happen again. So the system is aware of that. It's not as hands-on, but it's there. But in terms of where we could see financial crises, we still have a significant amount of commercial loans that are either delinquent or in default or have been restructured or pushed forward that are still underwater to the tune of a riding loss, an unrealized loss across the biggest Wall Street banks of $750 billion. That's just there, not being realized, but are actual losses. So if there were to be a situation where some component or hedge to those losses would go under, as it did, the credit derivatives that were supposedly hedges to the subprime loans back in 2007 going into the 2008 crisis, that could have a knock-on effect throughout the banking system, for the same reasons, choking liquidity and so forth. So it is a problem. It is a potential crisis in the making. And equally, I think the Fed would step in and, QE it up if that were to happen. First of all, obviously, we've seen an incredible rally in gold since this time last year and even year to date. And it's been pretty stable. Even when it's sort of gone just off its April highs, we're still looking at a very stable consolidation period. And central banks do continue to buy gold. They have bought, 3 straight record years. They're into the formulation of a fourth. And the latest reports from the Global Council are that 95% of central banks, so they will be increasing their gold positions over the years. That's pretty solid. The issue is what has changed and what's going forward with the reasons for them and other investors and sovereign funds and asset managers and insurance companies getting into the gold markets. And the safe haven status, we've seen multiple times. When there's a bank crisis, recent one a few years ago with Silver Bank, with, the sort of tech banks, the crypto banks, gold popped. But that was just a little bit. That was just a reactionary pop. But it showed that when there is a financial system crisis, gold will still come in. And it will come in more now than the 2008 crisis. And the reason for that is because central banks have been stockpiling gold as a solid tier 1 asset and as an asset that can be held in reserve across their own state banking system. So People's Bank of China, which is now over about 5% of its reserves in gold, and it's less than half of what they were in treasury bonds, from 6-7 years ago. It's basically cut its, sort of debt holdings and increased its gold holdings. It requires its state-owned banks to have a certain percentage of gold. And so as they grow their percentage in magnitude, the state-owned ones grow. And this is happening in India, this is happening in Brazil, this is happening throughout the world, where banks themselves also are purchasing gold, mostly outside of the Western bloc, but this is something that's continuing. So you see gold being a financial asset as well as a monetary asset, as well as this currency diversification asset, and a safe haven. All of this is growing, and I don't see anything on the horizon that's going to change any nation's mind about having this sort of independent to dollar form of hard asset in their reserves and for use as a kind of objective hard currency around the world. So that's one thing. And then we see growth in investors and growth in, just how ETFs are expanding and what solid growth has to be in real physical gold beneath that. And there are just a lot of tailwinds. Yeah, I mean, definitely the sanctions that the US and Europe placed upon Russia and Russian banks after they invaded Ukraine in 2022, it set off a kind of reaction across the BRICS nations, mostly between Russia and China, but basically with the idea that if this can happen here, whether there was support or disdain for the actual invasion, it can happen anywhere and for any reason. And so the manifestation of that is actually why gold has become more prominent in terms of stockpiling as that sort of objective asset, non-dollar asset. And it's also why there's been such a proliferation of trade agreements in currency, so basically taking back financial sovereignty that are not dollar based. So for example, rather than petrodollar type of transactions with respect to oil, there are direct agreements between China and Russia in terms of settling payments. Also, what we see as a development in terms of the sort of weaponization of sanctions on one side, or the SWIFT system, or the US dominated, European dominated payment system, and what's being built outside of that system are payment systems that China's prototyping, that Brazil's prototyping, that Russia's prototyping, that effectively will allow for settlement and settlement instructions, more importantly, that's really the key part of SWIFT, to be transferred between countries without going through SWIFT. So what that means is the reaction to this financial weaponization is creating an entire new financial architecture throughout the world, and trading and payment and currency and reserve alignments. It doesn't mean dollars going to go away. It doesn't mean that sanctions can't be used and won't be used as a weapon going forward. I think they will. But we also might see sanctions coming from the other side, with respect to, China versus Taiwan in terms of some disagreement and some, central bank squabble. I mean, we could see this develop in different ways over the years as these architectures kind of take hold. I think we're just in the beginning phases of the commodity bull market. We talked about gold, and I think everyone who has a position in gold should double it, and everyone who doesn't have a position should enter it, because, again, gold's a physical asset. It's a monetary asset. It's an asset of power. It's an asset of diversification, and it's an asset of storage of wealth. There are so many reasons and so many hard holders of gold that getting into that market for long-term purposes is, I think, important. Similarly with silver, we've seen the silver market pop up a bit more than gold so far this year. It was kind of, a sort of back burner thing because it didn't quite have that narrative connected to central banks that gold has, and gold was overpowering and overshadowing. And the reality is silver has that sort of secondary or its own primary aspect beyond what gold has with industrial uses. And even if our economies are slowing, and I expect that to happen in the US and throughout the world as per the numbers and as per what we're seeing, silver is a necessary commodity, and the supply-demand ratio is just off for what's required to continue to build the infrastructure of countries around the world, including solar, including industrial uses. So I would and am also in silver. Copper has taken a bit as sort of the third of that triarch because it doesn't have central bank appeal. So it doesn't have the monetary buzz attached to it, but it certainly has a transformatory industrial and energy connection, and it certainly has a dearth of supply relative to demand, and particularly in some complicated jurisdictions. But as a long term, I don't see it like sort of popping. I see it as just, hold it and just kind of, hang tight. Uranium, we've seen quite a pop in uranium just, since Israel, sort of attacked Iran, and the US attacked Iran, and even with the ceasefire, we didn't really see uranium back up that much. And of course, things can change at any moment. But I think this is because no matter what, there is a recognition that the processing of enriched uranium has to be something that, for the US anyway, and for the Western, it has to be something that's controlled and controllable by these nations. That's one of the first executive orders Trump put out, was about an energy emergency and a critical mineral emergency. Just recently, it was to deregulate some of the NRC, some of the Nuclear Regulatory Commission's sort of really onerous red tape process in terms of getting nuclear processing started, and I think that helps uranium miners. So in this situation, I'd definitely be in uranium miners as well as in uranium. But uranium miners are actually a bit easier to be in. You can't sort of buy uranium over the internet like you can with gold or silver or palladium or platinum. So that's the way to do that. And then as a backburner and all that, critical minerals, rare earths. I mean, right now they're depressed prices, but certainly China has been very clear about who its friends are in terms of processing and who gets tariffs and who doesn't. And even when there's sort of agreements, how that goes and how how they still have control over the supply chain from a processing and also a physical sense. And I think that's going to be a target for the U.S. It's been noted by the White House, following up from the last White House, as something to change. And I think it will. And I think that's going to give a bid to processors and miners of rare earths outside of what's currently involved in China. So those are all areas where we recommend, and they're just recommendations. I'm not, sort of giving anyone a financial advice here, but those sorts of trends that match geopolitics, that match the times, that match accumulation flows, and that match equity logic as well as hard asset logic in this commodity cycle are all parts of our model portfolios that we suggest and that we track on a regular basis.